This is the exact trading system that I used to make my first 100K in profits. But here's the truth. A technical strategy alone without this one thing is always going to hold you back from making multiple 5 and even 6-figure months. And once I implemented this, it made making my first 100K trading easy. What you need is one simple entry model and a specific capital allocation plan. And in this video, I'll break down exactly how I combine both to hit that milestone. You see, trading is a game of numbers. Running the same strategy on 100K will give you very different returns compared to trading it with 1 million and above. Let's do the math. If you gain 1% a week on a 100K account, not even including a profit split, that's $1,000. It's still good money, right? But 1% a week on $1 million in allocation gives you before profit split 10 times that amount. Do this every week and it becomes life-changing. Now, it took me 10 years to figure this out, and I'm going to teach you this in less than 20 minutes. So let's dive into it. So let's talk about actually what a capital allocation strategy is. And I'm going to categorize each element of this strategy and everything you need to know in order to plan and then execute, just like I did. First of all, everyone wants to become a prop firm trader. There's so many prop firms out there, it's difficult for beginner traders or even intermediate to know which ones to trust and which ones is best for you. For me, I'm at a point where I'm happy with my trading results, and in order to make more money, which is the purpose of this video to teach you, I just need to trade more capital. So CFD firms such as FTMO, FundedNext, FunderPro, they're great, but they tend to have max allocation of anywhere between 2 and 400K, which is good. Don't get me wrong. If you're happy making $1,000 or $2,000 a week on average, maybe slightly more if you're a very good trader, that's fine. But if you want to 10x your returns, and yes, it's possible, all you need to do is to stay consistent with your trading and trade more capital. This is why I transferred into trading futures, and this is my recommendation for you. Once you have a profitable edge, a system, and a proven track record that you can actually be disciplined enough to follow that plan and be profitable over a period of time, I'd recommend you using a futures firm such as Apex Trader Funding and start small and then add capital as time goes by. So now that we've covered which prop firm to go for, the next stage is account sizes and scaling accounts. So my recommendation is going to be start with a 50K account. Just one 50K account. Usually Apex do have very good deals on. So you can grab a 50K account for around $37, $38 a month recurring. And this video isn't an advert. It's just my recommendation. This is what I did and I'm still doing today. So it's a very low entry in terms of capital upfront expenditure. To gain a 50K evaluation, it's only a 6% profit target. It's usually 1 day to pass when you add that with an offer, and there's no consistency rule on the evaluation account. So compared to, say, an FTMO traditional classic 10% phase 1, 5% phase 2, this is much easier to pass as long as you have the right risk management strategy around trailing drawdown, because you'll have trailing drawdown systems in place on futures compared to a balance-based drawdown system on CFD firms. Once you've got yourself a 50K account, that's when you can double down and purchase another 50K. You then have 100K, and inside Tradeovate, the trading platform that I'd recommend to use with Apex, that's what I personally use, you can actually link trading account groups together. You don't need a third-party trade copier. You can link them all together, and therefore you're trading 250K accounts or really 100K in one go. And you'll keep scaling over and over again. It doesn't matter if this takes you 3 months, 6 months, or 1 day. This is the system that I'd like you to follow. So starting from 50K, doubling that to 100K, then doubling again to 1 million. Now let's talk about risk per account. So how to keep risk consistent when compounding results. You really want to keep a risk management strategy alongside your actual technical execution strategy the whole time that you're trading. And make sure that it's a specific strategy that aligned with that futures firm, such as balance-based drawdown or trailing drawdown. Also making sure that you're more intraday because you're closing your positions by the end of the day. You're not in a swing account, so you're not holding overnight or over days or weeks or months. So you do need to alter and refine your management strategy accordingly. Your risk strategy needs to be put into place that, in my opinion, serves as a longevity. You need to think ahead. If you're risking 5% on your first trade in an evaluation to get past quick, are you building healthy habits that you can follow through with? Versus are you risking 1 to 2% maximum per position to pass your evaluation, 6% profit target, that you can then consistently follow with live PA accounts? So my recommendation is to risk around 1% of your capital per trade, get a feel for it, be consistent, not put a time scale on how long or how quickly you can pass the evaluation stage. Focus on the process, focus on your strategy, and the capital allocation will come in time. Remember the maths. 1% a week on a 100K account is around $1,000 before profit split. That's still good every single week, but if you want more, and why not? 1% on 1 million allocation is around $10,000. This would be every single week if you can manage just 1% per week, which is very realistic as a consistently profitable trader before profit split. And you're spending the same amount of time, you're putting the same amount of effort in, but you're getting 10 times the profit. So remember, there's 3 growth phases here. Phase 1 is building the system. This should typically be from day 1 up to anything between month 2, 3. Phase 2 is going to be the initial capital. So after 1, 2, maybe 3 months, you should have your first 50K in funding allocated, and you can start trading that live. And then phase 3, typically from month 3 to 6 and onwards, you're going to repeatedly reinvest your trading profits into more evaluations, link those accounts together. My recommendation is 50Ks and group them into groups of 10, 20 accounts into one group, and you can trade them all inside the Tradeovate platform and just focus on small, consistent profits every single week. Now let's get further into the technicals. I'm going to start sharing my screen here. I'm going to start bringing up some charts. I'm going to run through everything from a top down. And what I mean by that is everything from market selection. What markets are you actually going to trade and why? We also then want to look at higher time frame structure. We want to look for a trending market, and then everything that follows that, right down to the stupid simple entry model that I'm about to share with you, including trades that I took with my students last week. So market selection is simple. The first thing is less is more. If you have a watch list that looks like this and you're flicking through one asset class to another asset class, all you're doing is giving your brain mixed signals and too much data. What you really need to do is minimize your watch list right down to a select few, even just one market that you can trade consistently day in and day out. How to choose which asset to trade? Well, for me, the trend is your friend till the bend at the end. You've probably heard that saying before. I learned it over 11 years ago, and it's still true today in the way that I trade. I look for a trending market, such as the NASDAQ or NQ. This is the chart right up to today, the 15th of August, 2025. And you can see without a doubt, this is a clean trending market. This gives us our directional bias when we are looking to trade along with the trend, and it can also give us key draws on liquidity even when we're deciding to fight against the trend. The key thing here is to have clarity in the market that you're trading. If you are trading a consolidating, range-bound, choppy market, you are not going to get consistent results. It's going to give you a headache, your equity curve is not going to look great, and you're going to have a really hard, stressful time being profitable. And when I shifted over from Forex into indices back in February 2024, everything changed for me. Let's run through a 4-hour time frame example and exactly what I'm looking for in terms of market structure, trend, and liquidity to give me a high quality, high probable, and high confidence in a daily bias. So we know that an uptrend is going to want to liquidate at some point. If you didn't know that, this is usually what happens. We will either run into a 4-hour low as a draw on liquidity, maybe a daily low if we have a more significant higher time frame low, or it may run into an area of inefficiency or imbalance if we have imbalance to the left. This is then the area that we want to wait for our lower time frame confluences and trade against opposing side liquidity, knowing that this is the overall market structure. We have liquidity resting above structural highs. When we have a trending market, we want to be on that side of the market. And only when we are expecting lower prices into an area of interest like such is when we are going to trade short into that. Another example is when we've just recently broken a structural high. So if we've had a previous structural high, we've had the pullback, we've had the mitigation of a draw on liquidity to the left, we've had the lower time frame confirmation, and we've broken above this area, price will then want to come back to rebalance if it leaves inefficiency in this area, pull back to collect more liquidity on the lower time frame before continuing to the upside. And there are going to be two examples that I'll be showing you and proof that I took these trades over the next 10 minutes. So bear with me. So to summarize the core principles of the entry model and higher time frame structure, we have market selection, filtering down your assets down to one or a small handful, and the markets that you choose ideally are a trending market at that time. Not every market is going to be trending every single week, which is why I like to alternate my watch list over a group of 2 or 3 separate asset classes. We want to use structure mapping, and if you're not too sure what that is, you can watch this previous video that I posted very recently, which covered exactly what liquidity and structure mapping is. That gives us a directional bias. So if we have a bullish bias on the day, that's likely because we are in a bullish market and price is retracing into an area of inefficiency, a draw on liquidity such as a higher time frame low, and we're waiting for that lower time confirmation to trade from that area of interest. The key setups is something that we are going to cover next, along with some live trade examples later on. So if we have an area of inefficiency to the left on a higher time frame, we'll call it a gap for now, and price is running back into this zone on a 4-hour time frame, we want to make sure a few things have happened. One, we've mitigated or even liquidated the entire gap, which has made efficient pricing once more. 2, we want to make sure there is a draw on liquidity taken, such as an engineered 4-hour low, or if we had a 4-hour low over to the left previously, price has come and taken that out as well. So let's start off with a 4-hour structure. High highs and higher lows. 4-hour is then printing lower lows and lower highs, but enters an area of imbalance or inefficiency. For now, let's call it a gap. The more confluence is in higher time frame liquidity, the better. Let's hypothetically speaking say that the overall macro higher time frame trend of this market is bullish. So we know that this is the pullback phase. What we also want to see is either a inducement at a nearby 4-hour low, or even a daily low, which would be even better. And if we didn't have this level, then we can use a nearby 4-hour target, also known as engineered liquidity. So price has come back into discount of a previous range, also not that necessary, into an imbalance or a fair value gap. We have 4-hour inducement in the form of liquidity, either to the left or engineered with recent price action, and a run into that liquidity on that 4-hour time frame. Now let's jump over to what a 15-minute entry model would look like inside of that sequence. So here's our 4-hour gap. This is price running into this after leaving behind a 4-hour low. 15-minute is running into these lows. We need to then wait for, once price has driven into this 4-hour low, timing. Timing is everything. If we are trading the US stock market, better make sure you're trading the US Open, which is 9:30 Eastern Standard Time or 2:30 British Standard Time. Now let's call this the New York trading session, where we're waiting for this run on liquidity and then simply waiting for a reaction in the opposing direction before our entry model, and then targeting buy-side liquidity, which could be previous trading sessions. We know that the first session of the day is Asia and the second session of the day is London. Now, in this case, Asia lows were taken by London. London highs have been left behind. London lows were taken before New York even kicked in. We've run into this higher time frame point of interest. We've taken 4-hour liquidity. We are potentially at the end of this pullback on a 4-hour in a bullish structural market, and we're looking for buy-side liquidity targets to trade long into. We have London highs and we have Asia highs. These are our targets that we want to be trading into. when we are looking for buy setups. Now, typically, risk to reward on futures, you're looking around a 2, maybe a 3 to 1. You could take as little as a 1.5 to 1. Any less than that, I would only specifically go for if you had a set small target in mind, something to achieve. Maybe you're only a few $100s away from passing an evaluation. That's completely fine. But usually try to target a minimum of around 2 to 1 risk to reward ratio. Now let's go over some live examples of the strategy, and we're going to go from a top-down approach. Remember, the first thing we're looking at is a trending market. We have the 4-hour time frame on NASDAQ or NQ here, and we can see very clearly that market is printing high highs and is closely followed with higher lows. So that's market structure. We are external range structure, printing new structural highs and higher lows, and it's a trending market. This is exactly what we want to see. Now let's zoom into the most recent structure where we have a 4-hour dealing range showing we are still within that bullish range. The other element I want to highlight is that we have an area of 4-hour liquidity which has recently been taken. So this means we don't necessarily very soon after this need another form of liquidity. On the 4-hour, price has created a higher high, a higher low, another higher high, come back to collect liquidity below this previous low, and gone on to create a new bullish dealing range. So that means that we're more likely to see more 15-minute continuations before then another 4-hour run on liquidity later on. But there's one more element I want to notice here as a 4-hour draw on liquidity before we drop down to a 15-minute to look for entries. And that is in this candle. From this wick to current price, we have an opening gap. You might call it a fair value gap, inefficiency in price, or an imbalance. They're all the same thing, different terms. Now, before price goes and breaks new highs, there's a high probability that this gap is going to be a draw on liquidity. It's going to draw price lower. It may only mitigate some of it, or it may fill the whole entire thing. The lower time frame entry model is going to dictate when we enter anyway, but we know that there's a high probability that price is going to retrace into this gap before continuing higher. When we jump down to the 15-minute, we're going to be looking at a number of key things. The first thing is timing. The second thing is 15-minute time frame structure. The third thing is liquidity. And then the final thing is going to be when to exit the market. So when to take your profits and risk management along the way. So let's drop down to a 15-minute where we can firstly refine this gap into this area. And before we move on, we need to know where we are in the time of the day. So I use 2 session-based indicators. The first one identifies where most of the trading is happening inside that session. So if I just show you the previous day, we have Tokyo, which is from midnight to 6 a.m. UK time, London session 8 a.m. till 10 p.m. UK time, and then the New York from 2:30 till 4:30. This is where most of the body of trading is happening during those sessions. And the second indicator highlights to me, again, I'll show you on the previous day, it highlights the crossover between London and New York and then the end of the New York trading session. So go over these sessions settings. We can go over this right now. So you need to select your time zone. History, you can have a maximum 100. So that means that when you're using bar replay, when you're collecting data or backtesting, that's how many days you can go back. We have the London session timings in here, New York session timings here, and finally the Tokyo session timings here. For the second session indicator settings, we have slightly different timings. They are in 6-hour periods. So for the Tokyo session, it remains as the midnight to 6 a.m. Then the crossover from 6 a.m. to 12 p.m. falls under the London time period. And finally, the crossover from 12 p.m. to 6 p.m. is the New York session. This allows me to identify the highest and the lowest points on this 15-minute time frame, which are key areas for liquidity. Now, because we're trading US indices, in particular NQ or the NASDAQ, we don't want to be trading the London session. And there's a reason why. It's 2 reasons why. If I play this forward and just show you London, the first reason is the lack of volatility. And to show volume in the market, we can go up to the top onto bar style, open up this drop down menu and go to volume candles. And the thicker the candle, the more trading volume at that moment. You can see there's very small candles inside London, just as small as the Tokyo session. But then when we look at the New York sessions, we can see from New York open, the volume increases. Same with the London, very small. A previous New York session, lots of trading volume. London, very small. Previous New York session, tons of trading volume. Another London session, very small, and so on and so forth. So if you want the main move of the day, you need to be waiting for the New York session. The second reason I won't trade US indices in London session is because London itself tends to be liquidated most of the time by the New York Open. Now, let's use our indicators to our advantage and plot out the session-based highs and lows, some of which have been taken. Asia low has already been taken by London, and the London high at the time has been taken also. But what's available is the Asia highs, which are also at the structural highs, and also the London lows. Now remember, the 4-hour draw on liquidity was this imbalance, this price inefficiency, this gap, whatever you want to call it, it's the same thing. So what I am expecting is for price, especially now it's taken these London highs, I'm expecting price to tap into these lows, and I'll wait for timing, I'll wait for New York session to kick in, and I'll be buying into buy-side liquidity, opposing side liquidity. And that's the same model that I'll be using day in and day out. So let's play this forwards. We can see price does take away from London at the beginning. Now we're into the crossover of London to New York. You see this time window here. New York trading session has not started yet. We don't have that background indicator has begun yet. Now we can see London newest highs formed were taken. That drove price lower into the London lows. That's now been taken, which has given us new buy-side liquidity resting above the newly formed New York highs. So we now have New York highs and Asia highs. We're in a bullish market. We're expecting these to be the draw on liquidity next. Price has manipulated down into the lowest point of the day. We've already taken Asia, now we've taken London, now we're manipulating the gap. All we need now is timing, and we need a retrace candle. Now this one here happens at 3:45. We're waiting for 2:30. So this is the perfect entry model, but at the wrong time. Timing is everything, and I'll show you why here. There's a lot of manipulation in the market. We can see price fails to commit, and it drives down again soon after New York creates a new low, which was right here. That's now been taken. New York session is now opened. We're just waiting for a 15-minute retrace candle, which we get here. This is your entry, stops below the low, and you're targeting either the New York high or the Asia highs, which is also the structural highs. Let's play this forward. New York highs are taken, closely followed by the Asia highs. Now let's fast forward to the following day, because the same thing happens on the very next day. I'm just going to play this forward through Tokyo session. And the first thing to note is the fact that we've broken and continued above these structural highs. So we're expecting that bullish market, that bullish trend that we identified as the first thing on the strategy is going to continue. We are going to wait for a London session, so I'm not going to plot out every single high and low if we're not trading London anyway. We're just going to see how London plays out, and then we'll look at session-based liquidity as New York kicks in. So there's the crossover. We have had the mitigation of this gap, so that's no longer applicable for today. All we're looking at now is a continuation based on session-based liquidity. So same as the previous day, Asia highs are still available. Asia lows have been taken. London highs are available, and so are London lows. Just like the previous day, all we're waiting on now is timing, liquidity, and also some news, which is at 1:30, an hour before the trading starts for New York. So let's play this forwards until New York opens. We get a run on liquidity inside of here. News has passed. This candle which swept and took liquidity closed bullish. So this is our entry, market execution, stops below the low, and our targets are either, again, at buy-side liquidity resting above London, almost a 2-to-1, or if you're looking to hold, you could trail your stop loss below 5 or 15-minute candles if you wish, and you could target the actual Tokyo high and the all-time high for around a 2.7 risk-reward ratio. So let's play this forward and see how this trade plays out, and it goes on swiftly before the end of the New York session, taking out both buy-side liquidity targets. Same principles, same entry models, same time of day, and same entry time frame. For those that love mechanical strategies, you can't beat this. Now, the last session I'm going to show you is the session that was actually yesterday, which was the 14th of August, where I took 3 trades. I'm going to show you all 3 screenshots now. The first one was 15-minute entry based on this exact entry model, which I will run through. The second one was a continuation on a lower time frame, which will be for another day. And then the last one was finally a counter trend position where I sold against the market because my confidence level was really high. But let's go over the markets now and cover that first position. So as always, we will start out with the 4-hour. What we can see is, again, we still are in a trending market. We've broken above this previous structural high and we are printing higher highs and higher lows. So we expect that to continue at some point. What price is doing most recently is coming back to fill inefficiency in price. So again, you could call this a fair value gap if you wish. I just refer to them as gaps, where you get this wick and this wick have left an open space. Price likes to become efficient before it continues the market. There is another reason why I was expecting lower prices first and then overall higher prices following the bullish trend. And that's a mitigation of this previous structural range. This doesn't happen all the time, but when you are in a new all-time high structural market and prices retracing, previous session highs in a bullish market are often respected. Now, there's a third area of interest that I was also looking at for sell-side liquidity to be taken before taking buys, and that is the immediate 4-hour low of the previous day. If price was going to pull back on the Wednesday and continue, it would have done so by now. However, it hung around for another 3-4 hour candle period where the market on the lower time is consolidating, and the icing on the cake is the fact that we had PPI and unemployment claims that afternoon, 1 hour before the New York Open. So there's one more element that I want to show you, and hopefully you're spotting it on that 4-hour bearish candle before I highlight it. Yep, you might have got it. From wick to wick, we have an imbalance in price, which is another 4-hour draw on liquidity. We'll call it a gap. So when we get sell side liquidity taken, we'll be buying from this area, and this opposing side liquidity is going to be our target. Let's jump down to the 15-minute. Now we have this consolidation that we can see from late New York the previous day into Tokyo session on this current trading day. We have the 4-hour lows resting below here inside this 4-hour fair value gap. Let's play London forwards because, just like I mentioned earlier, we are not trading the London session. And as soon as we enter the New York crossover, that's when our new time zone appears and we can mark out our session-based liquidity. So Tokyo highs has available liquidity and it's resting directly below the gap on the 4-hour. So we have Asia highs as available liquidity, which is resting directly below the 4-hour gap. Asia lows have been taken already, likely inducing early buyers during London, but we know that we're not trading this, especially the fact that we have a 4-hour low and imbalance below that price is likely going to target. London lows are also left behind. However, when you have a session-based low or high nearby a 4-hour draw on liquidity, statistically, most of the time price will take the 4-hour as well. London highs have been taken, so this is likely going to form a reaction short term, driving prices lower, and we know that we have news in around 1 hour, so we're waiting for that to likely drive in to the lows, taking out sell side liquidity, giving us a buy opportunity to target the opposing side liquidity. And that's exactly what happened. Price moves into the Asia highs, reacts, news kicks in, we've taken out Asia highs, which in the process has given us a new high of the New York crossover. These now replace the Asia highs as opposing side liquidity, again resting directly below this gap, which has not yet been filled. Price during news has ran straight through London lows, and like I mentioned, straight into the 4-hour lows as well, and has shown signs of bullish intent kicking into the market. What's the last thing that we are waiting for, guys? That's right, we're waiting for timing. So we're waiting for 2:30 to start, which is our trading time. We have a retrace candle at 2:15, and we have a following continuation candle right on 2:30. This is where I entered the market, and I show you my screenshot now. This is my initial take profit. And my management style was trailing my stop below every 5-minute bullish candle that closed because I'm managing my risk based on trailing drawdown. Let's play this forwards and we can see that price does reach the target. Being fully transparent, I'll show you my second position, which was a 1-minute continuation inside of here. Once I'd taken profits on the first position, I'd entered another position here, which again, I managed on the 5-minute, trailing my stops below every 5-minute candle closure. You can see the first one was taken out by this 5-minute wick. I re-entered the market on the 1-minute time frame, and the candle that took me out was, I believe, the very next one there. And then as soon as that 5-minute candle closed, I actually took a very short-term sell because we'd taken out all buy-side liquidity of the day. Tokyo, London, and New York highs straight into this gap, completely filled this gap, expecting a short-term reaction. I took a quick 1-to-1. I'll show the screenshot of the sell as well. And that continued to fall even after I'd closed for the day. That was a 6% day for me, 500K in Apex funding from start to finish. And many of my traders caught the same moves. So what are the key takeaways from this video? This system works because it's simple and it's repeatable, and it's built around proven concepts, trend, liquidity, and disciplined risk. Our checklist is which market to choose, choosing a trending market and giving us a directional bias based on structure and liquidity. We filter the setup based on timing, lower time frame session based liquidity, and a higher time frame draw on liquidity, giving us that area of interest. We want to not hesitate on executing when the market conditions presented are clear, and we manage our risk by targeting opposing side session based liquidity, understanding the fundamentals around drawdown, whether it's balance based drawdown or whether it's trailing drawdown, and executing with no more than a 1 or 2% risk factor on your capital. If you want me to help you to build your very own 100K trading system, you can work with me one-on-one. However, I am limited to how many traders I can take on due to the personal nature. If there is a link to apply below in the description, it means there are spaces available. If not, it means it's full. And before you leave, please make sure you are subscribed to the channel. I upload videos every single week, completely free, to help traders get consistent, confident, profitable, and making good money from trading. Last week's video shows the exact entry model that I use consistently to make 5- and 6-figure months. Go learn the trading strategy, and I'll see you on the next video, guys.